Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Monday, November the 20th, 2023. Of course, one of the main things to keep in mind this week, guys, is that it's Thanksgiving in the US. So we can assume that Thursday is going to be extremely low liquidity. Friday will be low liquidity, and probably even sort of Wednesday afternoon will be pretty low liquidity as well. So the thing is that there's not going to be too much bond issuance, corporate bond issuance this week. There aren't too many sort of major macro sort of events or sort of data. So we can assume that it might be a bit of a range-bound week, unless, of course, we get something sort of geopolitical. Talking about Wednesday afternoon, we do have the Fed minutes coming out Wednesday afternoon. Normally that's at 2 p.m. You guys will remember that at the last meeting, the Fed essentially said that, financial conditions were doing some of the work, some of the tightening, and it was a relatively dovish kind of meeting. Although Powell in his press conference was kind of, he gave something a little bit to the hawks, something a little bit to the doves. But I mean, technically, this is old news. It's from 2 or 3 weeks ago. But the issue here is if the Fed does want to communicate that they're a little bit unhappy with the recent sort of dovishness in the market, the fact that the yields have come down, the fact that the bond market is up, the fact that the US dollar is down, that's an opportunity maybe just to tweak, to massage the emphasis and the sort of the nuance of that of the Fed meeting minutes. So that's a Wednesday afternoon. Let's keep an eye out for that. On the other hand, they might just decide that things are going more or less in the correct direction and there's no need to adjust anything. So that's Wednesday afternoon. So just in terms of some of the sort of the big picture stuff, let's just look at a couple of sort of charts and just put a few things into perspective here. So if we look at the five-year break even, that's the sort of, where the market thinks about 5 years, the inflation will be over the following 5 years. So it's sort of like a proxy of medium-term market pricing for inflation expectations. We can see that's actually been going down. This is a daily chart. And you can see that, essentially for, the last 2 to 3 weeks, that has been heading downwards. So the Fed will be very pleased with that. And that's caused the market not to stress too much and maybe indirectly been supportive for the long end of the curve, because the market itself, this is not the Fed, is basically saying that, inflation expectations are relatively anchored. They seem to have found a sort of a range. If we look at a couple of other things as well, we can see that, for example, the real yield has also come down, which we'll see hopefully when this chart comes up. Yeah, that's, by the way, that's gold on the top here. So this is the 60-minute chart. This time it's an hour chart, but you can see that basically the real yield is this sort of blue and white one here. You can see that the real yield has essentially fallen as well since the beginning of November. And we're now, still at 2.2%, but that's come down from a high of about 2.5%. So the thing is that that's going to be a positive for risk on, maybe less of a positive for the US dollar, and a positive for stock. So the real yield is coming down. And also the other one which I want to look at, a couple more maybe, I want to look at the term premium. A lot of people have been talking about the term premium, and the idea is that the term premium is the amount of extra money which bondholders want to compensate for the duration risk, the risk of uncertainty of holding bonds over a long-term period. And basically what you guys can see, again, this on a daily chart this time, you can see that had reached up to almost 40 basis points. It had been negative for a long time. And a lot of people are saying that that term premium, based on the extra issuance from the US Treasury and the extra risk about potential inflation getting out of control and whatnot, that was part of the issue, that the long-term bond yields went up, the 10-year and the 30-year. Also the fact that we've got that bit of a sell-off in the equities. But as you guys can see, essentially it's gone up the last day or so. But basically, again, since the end of October, that's come in a little bit down from, about 40 basis points to about 21 basis points as we speak today. So that's 20 basis points less of term premium. So that indicates less risk in the market, less stress in the market, in the bond market, and less need to be compensated for holding a longer term bond. So all things considered, if the term premium comes in, that is considered, that's sort of slightly good for risk. The other thing which I might have a quick look at here, just to sort of in terms of overall pictures, is just the, let's have a look here. I've got the Fed funds rate minus the 1-year inflation swap. So what this is saying, and this is often mentioned by Powell and John Williams at the Fed, basically to determine how sort of tight. This is one way of looking at tightness in the market in terms of monetary policy. And essentially what we have here, we have the mid rate of the Fed funds rate, which is the white one here on the top. And as you guys can see at the moment, it's 5.375. And basically the inflation swaps, this is where the market thinks inflation will be in a year. It's kind of like what the market insurance price is for inflation. And as you guys can see, it's about 220 basis points. But basically it's been, so I mean, it's now sort of in a flat range, but essentially is has moved lower. And the spread here, which is what's interesting, the spread here is, which is about 3.17%. That is basically one way of looking at how tight monetary conditions are, because we're basically saying what is the midpoint of the Fed funds compared to inflation 1 year out. So that's like sort of a 1 year kind of gauge of it. And the reality is that historically, at a certain point, that was, that was negative for a long time. You see here all in 2020, 2021, beginning of 2022, that was negative. So extremely loose financial conditions. And then obviously, as we see the Fed started to step up all the hikes, this huge hiking cycle up here, we can see that gradually the Fed funds rate, you see here, we had inflation at the worst kind of moment here. We had inflation at 6%. For 1 year swap, and we had the Fed funds rate basically at zero. And so, of course, here you see that the sort of, the real kind of rate here was extremely negative and therefore extremely accommodative. And we all know that that caused animal spirits to rally and asset prices to rally, and of course, inflation. But gradually, of course, we see that, at a certain point, the Fed funds rate went above the 1 year inflation swap. And that's caused, in Powell's view and in Williams' view, they would say that monetary policy is quite tight. The Fed is quite tight at the moment because, sort of the real rate or the rate of the Fed funds above inflation is 3.17%. And so that's one reason that, Powell, I think in his last press conference said, I think we're relatively tight. There's maybe not that much more reason to sort of tighten anymore, to basically hike rates anymore. And also there's what's going to become increasingly important as a subject for debate over the next probably 2, 3, 4 months is there going to be some kind of mechanical relationship between these two numbers here? So what do I mean by that? I mean by that let's say, for example, the inflation swaps fall, I don't know, maybe to 1.5% or something. This is again for the 1 year out. Does that mean that the Fed they don't want to keep the policy too tight? So that means that mechanically they might have to start cutting the Fed funds rate just to maintain that differential, that sort of relationship between the two numbers. Because if the inflation goes down and the Fed funds rate stays where it is, that means that technically the market is getting tighter. Money is getting much, much tighter. So maybe the Fed wants to keep it around about this level. So that's just something very interesting, not just with this time frame, but just in general, to be looking at the relationship between the Fed funds rate and the inflation levels, inflation swaps, because that maybe is going to be really more important than the actual individual level of inflation or the level of the Fed funds. It's going to be that relationship which ultimately determines how tight things are. Anyway, so just in terms of, that's kind of like the bigger picture stuff. So obviously what that means is that, we've had a pretty good rally. Based on all of that, we've had a pretty good rally in, that we've seen the VIX coming down here, VIX, more or less at lows. We've seen the ES, we've seen all the stocks coming up. So at this point, what happens next? As I say, it should be, a relatively calm week in theory. One thing we do have the 20-year auction at 1 p.m. this afternoon. And we'll remember that the last auction of the 30-year auction was pretty horrendous. So we'll just go back. Let's see if I can find it here. I want to just show you something about the curve here. So if we look at, I think the US curves here. Yeah, so what's kind of interesting here, guys, I want you guys just to notice something here. So a lot of people saying, oh, we've got this 20-year auction this afternoon, and that is going to determine whether there's, great demand for the long end, or if it's a bit, or if it's a poorly received auction, that's going to, mean that no one wants to buy bonds anymore. And there's a degree of truth in that at this point, any auction on the 20 and the 30 and the 10-year tenor is going to be important. But keep in mind that the 20 has a very narrow kind of demand for it. It's the market doesn't like it particularly because it doesn't find that it's really long enough. It prefers the 30-year or prefers more like the 10s and the shorter one. And that's indicated if you just look at the shape of the curve in the US, you can see here that the 20 actually pays more than the 30. And you see that the curve, it's a bit weird. There's basically this kink between the 10 and the 30. And some of that is just because that this tenor, which has only been around for the last 3 years, it's just not that popular. It's like there's not that much demand for it. So all I'm trying to say is that even if the auction today at 1 p.m. for the 20 is a little on the weak side, it is a particular beast. It is a particular instrument which is not really loved by the bond market. So it doesn't necessarily portend, like a huge rip higher in long-term rates. It could just be something a little bit idiosyncratic. I think we really have to wait to the next cycle of 10s and 30s to get a truer read on that. But anyway, nonetheless, that will be interesting just to see how that is received this afternoon. The other thing in the news, of course, everyone's talking about the fact that the founders of OpenAI, who introduced the ChatGPT, which is Sam Altman and Greg Brockman, they resigned. I think it was last Friday evening. And there's a lot of kerfuffle over the weekend about them maybe coming back onto the board of OpenAI or whatnot. But then we've got the news, I think it was just from early this morning, that they've been hired by Microsoft with a lot of autonomy to start up their own kind of AI research project, which is going to be very autonomous and absolutely funded, fully funded by Microsoft. So essentially now what's happened is that Microsoft has taken on board these two, very influential, apparently very, very talented pioneers in the AI space away from OpenAI. So all things considered, that's going to be a net loss for OpenAI. And we have to say that that's probably going to be considered, absolutely as a positive for Microsoft. So I'm assuming that Microsoft, we see here in the pre-market, trading up about $4 from the close. You see the close 369 up to 370, 373. So all things considered, that might be taken pretty positively by the market for Microsoft. That's going to be something interesting to be looking out for. So that's about it, guys. I don't think we have any other data this morning. Just in terms of the equities, again, what I'm thinking is that at this point we could have a little pullback, or it could grind a little bit higher. I mean, I just don't know. I don't have a high conviction call on that because the market's come a long way, so it'd be absolutely normal if it just sort of drifted down a little bit. On the other hand, we do have the bond yields, which seem to have found a range. So let's have a look at some of the bond yields, which seem to have found a range. Just want to have a look here. Now, and what you're seeing here, guys, I think the 20, sort of the 2-year at the front is pretty much just going to trade within a tight range here because it can't really go down. It's come down quite significantly since the CPI and the last Fed meeting. So at this point, I think in order for it to have much more downside, we would probably actually have to get continuing very, very weak real economy data or some kind of signal from the Fed that they certainly have stopped hiking and maybe even thinking about the rate cuts. But that's a long way away. I think that could be 6 to 9 months away. So I think at this point, the front end of the curve here pretty much anchored. The 5 is a little more volatile, just because I think that's going to be the one which is maybe not so much like the 2 years anchored because it's really waiting on the Fed for the next big move. Whereas I think the 5 is the one where that could reflect most sensitively in a most sensitive way, just sort of real economy data and that kind of thing. So I think the 5, but again, I think it's going to be pretty much moving in within maybe a 10 or 15 basis point kind of range. You'll see here that the 10s. Again, and the 30s pretty much not doing too much here at all. If you look at the 10s to 30s spread, which I think I've got here somewhere, is that the 10s to the 30? Yeah, so you can see here, guys, it's interesting. You look at the 10s to the 30s spread. That's very, very tight range there. Okay, so essentially what I'm trying to say is that the long end of the curve here, the 10s and the 30s, are more or less trading in a similar kind of way there. You may as well just play the 10s or play the 30s. Same kind of thing. There's not a huge amount in the spread there. I did a video over the weekend talking a lot about the shape of the curve. I do believe that, yes, when and if the Fed starts their cutting cycle, of course, historically, that should lead to a pretty aggressive bull steepening. The question there, as always in trading, is going to be timing. Will that take, a month? Will that take 3 months, 6 months, or 15 months? We don't know at this point. Everyone is putting out there, we're having a recession in Q1 or Q2 or Q3 or Q4, or maybe no recession, or maybe a soft landing, or maybe a hard landing. I think the best thing at this point is to trade tactically as much as it's possible, because there's extremely volatile trading conditions. And so, the market is flip-flopping every day. It's good for people who day trade. But for people trying to put on trades, longer than a week or two or three or four or five, it's quite challenging at the moment. And what I'm trying to say is that when the Fed does give an indication that they definitely have come to an end of their hiking cycle and they're starting to get close to thinking about cutting rates, there's going to be a very aggressive bull steepening. There'll be plenty of opportunity and time to get into that. So that's interesting. But basically, the point is that if bonds, we see the real yields seem to have found an equilibrium. Inflation seems to have found an equilibrium. The term premiums come down. The nominal yields themselves are all kind of stabilizing within a 10 or 15 basis point range. I think that is, broadly speaking, let me just put it this way. I don't think it's negative in any sense for the equities. So although the equities have come a long way, do I think they're going to collapse? Absolutely not. I mean, that I think we'll have to wait until the unemployment situation worsens, until earnings worsen, until we have significant deterioration in the real economy. And at that point, maybe we can start to see the equities come off. But my best case scenario is that, before Christmas, the equities will, maybe have a little bit of a pause here. They might do a bit of a pullback, maybe range trade a little bit, or they might, on the other hand, they might just sort of drift, a little bit higher and, test some of these levels here and some of these levels there. The same in the NASDAQ. The NASDAQ's a little more positive in a sense. Obviously, it's getting close to that 16,000 level again, which is, it's like a double top. Do I think it's going to rip right through? I don't. But, I don't, again, think it's going to sort of collapse. I think, it might just sort of test through, maybe push a few stops, run a few stops. And, probably the reality is we're going to have to wait until January to see really what the next major move is in the markets. As always, guys, keep an eye on the relative strength index. That has been underperforming, although the Russell had a reasonable week or two, but it's still underperforming. The breadth of the market is improving. The breadth of the market is improving, by which I mean the number of companies in the S&P 500, which are above their 50-day moving average. I think it's now about, I just saw something this morning, 60-70%. Anyway, the point is that the number of companies above their 50-day moving average is definitely improving, but it's still, the market breadth is still relatively narrow. So that's that. Finally, just quick talk on oil. Listen, it seems to have bounced off its level. We're a little bit long, so I'm happy to see a little bit of green. Again, though, what I was saying the other week is that oil, there's a series of challenges which the bulls have to overcome, and they've overcome a few. So I'll put this here on the 4-hour chart. You can see that my first challenge was just getting through these fib levels here, and to be honest, they've done that. So I have to say bravo. So they've got through the 38, the 50, and the 61%. So that is looking. This is the first moment where I'd say that I'm getting a bit more bullish on this. We do have a down trend, so we have to get through that. But if we can get through that, I mean, then we just keep on, facing these hurdles. So the next one will be, 79.60, et cetera, et cetera. But at this point, looking reasonable. But again, it's still, nothing to get super excited about. But the time spreads are slightly strengthening, and maybe this will turn out to be maybe a short-term bottom, because we all know the Saudis and the Russians. There's a lot of talk with their meeting coming up this weekend, this Sunday, in about 7 or 8 days. That they may deepen and certainly prolong their unilateral cuts. But of course, we have to figure out the demand side as well. But so far, oil looking okay. The other thing I just want to draw your attention to, guys, after the market, I was talking about it last week, Moody's, they didn't upgrade Italian bonds, but they basically took them off the sort of the downgrade watch. So that was quite a positive. And we can see here that the BTPs, if we look here on the 4-hour chart, they are doing pretty well. And the spread, you can see here that the spread, actually I've got it on the Bloomberg chart, it's a bit easier, that this morning we gapped, the spread gapped down lower. So you can see here on a 3-minute chart, this is the spread here. So this is Friday close, gapping down lower. Now kind of pushing up a little bit. But basically that was, relatively positive news from Moody's, the rating agency, sort of saying that Italy was in no danger of being downgraded, which is not to say it's out of the woods, but certainly that immediate danger of being downgraded into junk status has dissipated for the time being. So it's going to be quite interesting. Some commentators are calling for the spread by the end of the year to go to 150. Others are saying that the bigger issues about sort of a percentage of debt to GDP and issuance will ultimately make this spread go a little bit higher. We will have to see how that all goes. Okay, guys, so that's about it for this morning. We'll be back in touch tomorrow. Thanks so much. Bye.